Tom, you look at ASX 200 companies all day long. What are the results telling you about costs and inflation?
Well, they're telling us that that's everywhere. I mean, across industrial Australia, it's not a company that hasn't mentioned it. And the challenge is really how can they pass those costs on to consumers and businesses and ultimately maintain profits. Strong companies like Woolworths and Coles are struggling to do it. We've seen that in the last few days. And then companies that are in weaker positions, think about an Ingham's, processing chicken, trying to sell into Woolworths, they're really in the pincer as feed costs go higher, wage costs go higher, and they're not able to get out the other side. So it's a bit of an issue for industrial Australia.
So particularly for retailers, how much of the issue is inventory popping up in these results, given that we saw all those shortages earlier in the financial year? Have they now stockpiled?
It's a huge thematic, this one, because if you roll back 6 months, what we had was very strong demand and supply chains that looked like a bowl of spaghetti. And so you roll forward 6 months and these companies have ordered a lot of stock. And now we're in a bit of a weakening demand environment. And so if you think about a company like Breville, which reported a couple of days ago, they doubled their inventory. They've got $450 million worth of inventory. That's a lot of toasters. And so they're going to have to roll through that. And they went at pains to explain that that won't impact margins, but it will be a challenge as we roll forward to work through that stock.
And what about the hike in interest rates? Is that showing up yet in any results? And then what's been the commentary from executives about how they see it's going to start having an impact?
Well, the results are backward looking, as we know. So the first 6 months of the year was actually pretty strong. So the results that companies are presenting is pretty good. The look forward is more challenging. You think about interest rates, they're 185 at the moment, and the market's expecting the cash rate to get to close to 3% in November. So Christmas is going to be the litmus test. I think that's going to be when we'll know are these interest rates really having an effect on consumer spending.
So are retail stocks doomed when you put together the fact that they're not able to pass on costs to consumers on the whole at the moment? Interest rates haven't yet truly taken effect and they've got to build up in inventory.
Doomed is a very strong word, so I won't say doomed. I mean, the market's forward-looking, so a lot of these stocks are already priced for a slowdown. The question that we have is how much of a pull forward has there been? So home furnishing, clothing, all these sort of areas which saw huge booms through COVID. How much was a pull forward, and do we see a little bit of a pause in buying? So time will tell, but some of the stocks are starting to reflect that outlook.
So which ones would you buy?
Frankly, I think you're better off just keeping your cash in your wallet for the moment. I think the sector still needs to bide a bit of time, come back in 12 to 18 months and we'll revisit that one, I think.
Are there any particular ones that you like?
Well, from a consumer perspective, we're actually pivoting more onto the travel side. So if you think about what happened through COVID, everyone spent a lot on goods and it's going to be hard for those companies to work through that. On the flip side, they didn't spend anything on services and travel's a perfect example. So Qantas actually looks pretty good. It's not a retailer. It actually had its result out today. The stock's up. They're in a pretty good spot. So our expectation is that even as things slow, travel spend will take a bigger share of wallet as it's coming off a lower base.
So like things like Flight Centre as well?
Correct, yeah.
What's your gauge on how REITs will perform from here? The listed real estate sector, they're buffeted by interest rates, of course. What's your view on them?
The property trusts are probably ground zero for higher interest rates when you think about it. And it's really sort of three reasons. If you think about the first is the interest bills going up, and that's going to dampen the dividend that people get out of those. So that's the first issue. Secondly, they've been a big beneficiary of lower rates through cap rate depression and ultimately higher asset prices. But sort of like gravity, as interest rates rise, it's going to have a dampening effect on asset values. And so if you think about what we've just reported, office prices as an example have just gone up again. They're the highest they've ever been, but vacancy rates are 30 to 40% in Sydney and Melbourne, so it doesn't quite gel with us. And then the third impact, is just the income that they're able to generate. So what is the income these assets can generate? And that depends on the sector. Industrial is still quite strong, but if you think about residential, Stockland flagged that inquiries in July were down 50% for their residential book. Now it's just one data point, we don't want to get too bearish, but certainly there is a question mark on that outlook.
Tom Richardson, thank you very much for your time.
Thanks, Elise.